You are discounting the cash flows at a rate lower than the promised rate. And the third one is, I'll be civilized and copy things. It's called a discount bond, where the bond value is actually less than face value, which happens if and only if yield to maturity is higher than the coupon rate. Those terms, premium and discount, does not and should not have any value judgments. Premium simply means the value of the bond is greater than the face value. That's it. One of the reasons it could be the issuers chose to have a high coupon at the end, at the beginning. So let's go back to this one. Suppose I decided when I'm issuing this bond, I'm going to have 0 coupons. That means you're going to wait exactly for 30 years, and 30 years from now, I promise to give you $10,000. We have bonds like that. Back in 1980s, IBM issued a 50-year 0 coupon bond, and people bought it. So if you pay me $498.47 now, given these YTMs, actually let me make it a little bit more respectable, close to where we are in the market now. If you pay me $22.72 and some change now, I will promise to pay you $10,000 30 years from now. Is this a discount bond? Yeah, you don't get more discount than this, okay? In fact, sometimes these are called deep discount bonds. That doesn't mean it's a bad bond. I just, as an issuer, I chose not to give you any coupons. And as the buyer of this bond, you chose to buy it. Or I could simply say, okay, how about I actually pay you a little bit faster? I'm going to give you 20% coupon. That means every 6 months, I'm going to pay you $1,000 for 30 years. And 30 years from now, I'll pay you another $10,000. But for that privilege, I want $33,000 of your money. I mean, this is deep premium, right? But that doesn't mean this bond is better than that 0 coupon bond. It's just a different cash flow. So premium doesn't mean good. Discount doesn't mean bad by itself. A bond can start premium, as the rates change over time, can end up being discount. Or the bond can start discount, could end up being premium. And let's look at the rates just 1 year ago. The 30-year bonds, bond rates, they increased by 56 basis points over a year, okay? It is 425 now, but 1 year ago they were 369, all right? So let's think about it. Let's think about a bond where coupon rate is, let me see, 4%. Okay. A year ago, the yield was 369. Is this a premium bond or a discount bond? Remember the test? You compare it to the face value. So relative to the face value, bond value is greater or less than the face value. So it's a premium. But now things change. Yield to maturity is 425. Suddenly it's a discount bond. It's the same bond. The only thing that's changed, the way market viewed how the future values should be discounted. Of course, we know what happened during the last year or so. At least until about June, Fed kept increasing the interest rates. hence, not only short term, but the long term rates also are going up. But it kind of also shows you, I'm going to kind of connect this to interest rate risk, which we're going to cover, of course, next Tuesday. As interest rates increase, value of bond decreases. So they're inversely related. It kind of makes sense. Interest rates increasing means I am discounting the future payments, which are fixed, at a higher rate. So I'm applying a more penalty in a sense to bring it to today. As interest rates go down, bond values go up. But that brings the interest rate risk. Because if I'm owning this bond, if I'm going to keep it until maturities, I don't have a problem. And a lot of pension funds do that. But what if I needed to sell it for whatever purpose? If there's a big hike in interest rates, I'm going to actually end up realizing losses. This actually happened for Silicon Valley Bank last year. That is one of the reasons they went down. Banks are in the business of borrowing money from other people, like their depositors in the market, and lending it to other people. Okay, and most of the deposits of Silicon Valley Bank were from their own corporate clients, which were not federally insured. Only 250,000 is federally insured. And suddenly, these guys decided to say, we're going to withdraw some money because they were concerned about possible health of Silicon Valley Bank. And banks typically hold some liquid assets to cover such deposit runs. And Silicon Valley Bank had considerable liquid assets, but they were invested into long-term treasury bonds. They are liquid in the sense that you can sell $100 billion worth of treasury bonds probably in less than a minute without actually getting a haircut on the deal, which means there are enough buyers in the market. It's a very deep market. The trouble is they bought these at relatively low yields. I think their average was about 360. So at 360, they would have paid 10,730. In fact, to make it simple, let's start it at par. And if you're just keeping these in your books, and there's a way of doing that in accounting, these are securities held to maturity. You don't have to mark them to market. You book them at their original cost, but certain securities are for trading. You mark them to the market. But in order to cover those deposits, they had to sell some of them. And the rates were already as high as 450. They lost 15% on that investment. And they basically had to realize, technically speaking, they had already lost that money, but for accounting purposes, they had to realize $2 billion loss. Silicon Valley Bank had assets close to about 200 billion. That means even for a well-capitalized bank, your capital is probably not above $20 billion. Well, in that case, you just lost 10% of your capital in just first deposit run. And Fed, seeing what was going to happen, they took them in, right? The problem was they did not manage the interest rate risk of their portfolio. I mean, I done some consulting work for these guys. We actually noted that you have an interest rate risk because most of your deposits are uninsured. If there's a bank run, if you're not managing the interest rate risk of your liquid assets, you're going to be in trouble. Of course, they didn't listen. What are you going to do? We only do risk management. So that's what the interest rate risk is all about. And we're going to talk about the longer is the maturity of a bond, the higher is that risk. If they were holding only 5-year bonds, they would have lost only 0.4% instead of, I'm sorry, 4% instead of 15%, right? They would have survived that. Or the higher is the coupon, let's make that 450. The higher is the coupon. If the rates went up to 5%, you would lose about, for this 5-year bond, 2.2% of your investment. But if the coupon rate was 20, let's do 450, 1687, not much. So given everything else the same, higher coupon rates is low, less interest rate risk. Again, giving everything else the same, higher maturity is more interest rate risk. But we'll talk more about that next week. So I'll see you guys on Tuesday. If you need extra help, especially tonight and tomorrow night, anytime after 7 o'clock until midnight, you can contact me. I can do a Zoom call with you guys. All right? Let me save this.